Very good morning, friends. I guess I'm audible. So, hope everybody is doing good. So, I think let's start. I guess last time we were discussing some accounting terminology, if I rightly remember. And I think I've given you exposure on the term assets as well as equity and liability. I think that's what we stopped. If you could just confirm that to me. I think we covered assets and we covered equity and liability in the previous class. Okay, that's perfect. So now we're going to take another term with you before we take things forward. So we know asset, we know equity, we know liability. Now I'm going to discuss the term income and revenue. There are two terms, that is income and revenue. As far as the fourth term is concerned, expense, that we've already discussed. So that is indirectly covered when we're discussing the concept of assets. So let's begin with the third accounting term, and that is income versus revenue. Whenever I look at the term income and revenue, there is always a small little question what comes to my mind. And I think let's put that question to you as well. What do you think is bigger? Is revenue a wider term or is income a wider term? So, which out of the two is supposed to be wider in nature? Let's get your inputs. So, I'm getting a majority of the answers revenue. Some people are saying income. So, there's a blend in terms of income as well as revenue. Okay. So, I think let's give you the answer right away. I'm just going to write an equation and put the question once again to you, and let's see what is your reaction. So when you make an income statement of the company, mind you, what is the name? It says income statement. We don't say that it is a revenue statement. We say it's an income statement. So when you look at the income statement, let me also put a small little input to you. The equation goes like this. We say total income. We say that total income is equal to revenue. It is equal to revenue plus we can say other income. So please analyze this equation carefully, and I'm going to put that question once again to you. So we're saying that total income is revenue plus other income. So let's put that question once again to you. Do you think revenue is wider or do you think income is wider? Total income is revenue plus other income. So what do you say in this particular case? Is income a wider term or is revenue a wider term? And that's right, income is a wider term. Now, let me explain you the distinction in terms of what is revenue and what is income. Now, when you say it is revenue, I would say revenue is something which arises from operations. Revenue is something which arises from, you can say, business operations. So when I'm looking in terms of revenue, we're looking at what is arising from business operation. Now, when I say business operation, it means arising out of sale of goods or rendering of services. So whatever is my business, let's say if I am in the business of selling garments, then I would say the sale of garments results in revenue. Let's say, for example, I am in a business of selling stationery, then the sale of stationery is supposed to be revenue. So we can say what is business operation is what is arising out of sale of goods if you're into selling of goods, or if you're a service provider, then we can say rendering of services. So whatever comes from the sale of goods for a company, whatever comes from rendering of services of a company, that is supposed to be called revenue. So what is supposed to be other income? So we can say, as far as other income is concerned, it is something which is not on account of business operation. It is not on account of sale of goods or rendering of services, something which is not business related. Let's say, for example, you earn a rent. It's not my business in terms of renting out property. Let's say, for example, you make some investments, you earn some interest income, you earn some dividend income. So all this is not related to business. So we can say earning of a rental income, earning of an interest income, earning of a dividend income, etc. That is other income. So when I say the word total means what is coming from the business operation and what is coming from non-business operation. So when you add what is coming from a business and what is not coming from business, so total, the word total itself indicates that you are getting something from business and non-business put together. I hope I'm pretty clear. So mind the words, it says total income. So let me just consolidate this to the benefit of those who have just joined in. So we're looking at the two terms. One is revenue and one is income. So remember, when I use the word income statement, we don't say it's a revenue statement because income is a wider term. Income means whatever is the source of income. So whatever is the source of income, whether it is out of sale of goods in which you deal, whether it is on account of renting of services, so whatever is business related is supposed to be revenue. And if you get something which is not related to business, you're getting some rental interest, you sold a machinery at a profit on sale. So all that is going to become other income in nature. Add the operations and non-operations put together, that becomes a total income. Are we fairly clear with the two terms revenue and income? So far, so good. Okay, that's wonderful indeed. So I think my accounting terminology is over. Now, I'm going to do something which people from the accounting background would find it baby stuff. But I think this is more devoted to people who are learning accounting for the first time because I need to give you a good foundations on which you're going to construct your entire building. So what we're going to do, we are going to learn the art of double entry bookkeeping. So I think I need to give you two inputs to begin with. So before we take it further, I'm just going to expose you to two simple little things. One very important, watch this carefully. When you come to accounting, I would say there are two bases of accounting. Now, this is slightly technical for those who are learning this for the first time. So please watch this very carefully. So when I'm looking at accounting, I would say there are two bases of accounting. One is called mercantile basis, what is also called accrual basis, and one is called a cash basis. Don't get worried on what is accrual or what is a cash basis. We'll see the things, but just remember the terminology. So when you're looking at the basis of accounting, I would say there are two bases of accounting. One is called accrual basis. I call it as accrual basis of accounting. It is also called mercantile basis. So one of the bases of accounting is what we call accrual basis or what we call mercantile basis. And the second basis of accounting is what is called cash basis. Now, please, let's understand this very carefully, and then I'll give you some notes on that. Remember, a business is supposed to record incomes and expense. Mind the word. A business is supposed to record income and expense to get a profit. So I'm not looking at expense which creates an asset. If you remember my first terminology, I said that when a company incurs an expenditure, it's either revenue expenditure or it creates an asset. My focus now is on the revenue expenditure. So you can see on one hand is income, and on the other hand, you've got revenue expense, not all expense, because other expense will create assets. So if somebody were to tell me that how do we calculate a profit of the company, I would say in order to calculate the profits of the company, you will consider the total income, what we have just understood. And from this, you'll reduce the expenses, and which expenses which are revenue in nature, not the total expense, not those which will create an asset. And that's how we are going to get the profit earned by a company. Let me put it again. So we've seen terms like asset, we've seen terms like liability, we've seen incomes and expense. Now, get the picture clear. If you want to calculate a profit of a company, if you want to calculate a profit of the company, on one hand, you got to consider the total income, whether it's revenue, whether it's other income. So we're going to consider total income on one side, and you're going to consider expense, only those which are revenue in nature, not those expense which are creating an asset. So when we said a company incurred an expenditure and you've already got a benefit for the same, so you are going to consider those expenses out here. So from the total income, you will reduce your expenses and the net figure is called a profit. I hope I'm clear. So we've got total income on one side and we've got the revenue expense on the other side and we get a profit. Now, when you want to calculate a profit of the company, there are two bases of calculating the net income. You can say the profits of the company. One is called accrual basis and one is called a cash basis. Now see what is the difference between the two. So when you're considering your income and when you're considering your expense on accrual basis of accounting, the concept is I will record an income when it is earned, not necessarily received in cash. I'll give you an example. Watch this and give me an answer. I'm going to record an income when it is earned. It does not make a difference whether I received it or not. So let's say, for example, I sold goods to a customer on a credit. He did not pay me the money at this stage, but tell me, have I earned the income or not? Have I earned the revenue or not? What do you say? I made a sale of goods on a credit basis, and that's rightly said. I have already earned the money. I've not received the money. On accrual basis of accounting, you are supposed to capture the income. I'm using the word income because it's revenue and other income both when you earn it. So incomes are going to be recorded when they are earned. It does not make a difference whether they are received or not. So we're not concerned with whether actual collection has taken place or not. So when you sell goods to someone, whether he pays the money to you at this stage or not, but you've earned it. So if you've earned it, collection is not important. Mind the words. The collection is not important. The receipt is not important. You need to consider in accounting what you've earned. Similarly, when you record an expense on the basis of accrual basis of accounting, we are going to record the expense when it is incurred. When it is incurred, it does not make a difference whether you paid that money or not. The expenses will be recorded when they are incurred. So, for example, if I made a purchase of goods from a supplier, if I made a purchase of goods from a supplier and I did not pay him money, but have incurred the expense, so I'm going to record that expense irrespective, it's not yet paid. So, remember one thing. If a company wants to calculate the profits on accrual basis of accounting, you need to consider incomes as and when they are earned, not necessarily received in cash. You're going to record the expense when they're incurred, irrespective they are paid or not. We'll take more examples later, but as of now, just remember the key word is earning, the key word is incurrence. Okay, let me, I think, test you on one or two more examples before we go further. I hired an employee and he worked for me for a period of 1 month, but I did not pay him salary as of now. Have I incurred the expense? I hired an employee and I did not pay the salary. Have I incurred the expense? Yes. Because I've already incurred the salary, though not yet paid, I will record the expense. So the moment you incur it, whether you pay it or not, doesn't make a difference. Good. Let's go further. Now, when you're looking in terms of cash basis of accounting, the incomes will be recorded only when they are received in cash. The expenses will be recorded only when they are paid in cash. The focus is absolutely different. Okay, so I get a question, Sakshi. In both income and expense, we need to consider matching principle. Yes. Because if you go to record incomes when they earned, you go to record expense also when they incurred. You cannot consider one on receipt and other on a payment, other on an accrual basis. So you need to consider consistency. Earning is important, receipt is not. Increment is important, the payment is not. But when you say cash basis of accounting, you are going to record incomes when received in cash. You got to record an expense when it is paid in cash. Let me ask you a simple question, the same question which I asked you on accrual. Let's say I sold goods to my customer on a credit basis. Let's say I sold goods to my customer on a credit basis. Is the income going to be recorded? I made a credit sale. I did not receive any money. Am I going to record the revenue in the books of accounts? And that's right, he said the answer is no. Because I did not receive the money, I'm going to record the income only when I get the money, not when I earn the money. Similarly, if I made a purchase from a supplier and I did not pay him money, I made a purchase from the supplier, but I did not pay money. It was a credit purchase. So am I going to record this if I follow the cash basis of accounting? And that's right, he said no. So I think the position is totally different in nature. On accrual basis, receipt and payment is irrelevant. Receipts and payments are irrelevant. So what do you need to do? Have you earned it? Record it. Have you incurred it? Record it. And what is important is, have you received it? Record it. Have you paid it? Record it. Now let me give you a caution at this stage, and that is companies are required to follow on a mandatory basis an accrual basis of accounting. So when you're going to record your books of accounts, you need to on a mandatory basis consider an accrual basis. Companies cannot prepare their accounts on cash basis. They need to record an income and expense when they earn it, when they incur it. The cash receipt and the payment is irrelevant. Am I absolutely clear so far? Are we clear with the concept of accrual and the concept of cash basis and what is to be mandatory applied? Okay, I think I'm getting a question. Can you repeat that? Okay, let's put that once again to you. So please hear this carefully. I said there are two bases of accounting. Now, before that, you need to keep one picture in mind. The objective is to calculate a profits of the company. Mind every word of what I'm saying. The objective is to calculate the profits of the company. Now remember that when you are going to record the profits of the company, on one hand, you're going to consider total income. What is total income? Revenue plus other income. And you're going to record the expenses on the other side. Which expenses? Which we said the benefits already obtained, and that's revenue, right? Not all expenses. So in a company, you're going to consider the total income minus the expenses, which are revenue in nature, and you're going to get the profits of the company. Now, in order to calculate the profits of the company, there are certain rules to, consider income and expense. Since you want to get the profits of the company, there are certain rules to consider income and expense because profit depends upon two variables. It is supposed to be income and it is supposed to be expense. So when you're going to record the income and expense, there are two bases of accounting. One is called accrual or mercantile basis, and the other one is called a cash basis of accounting. Now, cash basis is pretty simple, doesn't take much of your times and energy because you will record the incomes when you get the money. You're going to record the expense when you pay the money. So it's as simple as that. I don't think so the cash basis needs any kind of explanations because you would record an expense when you pay it. You're going to record the income when you receive it. Paisa aaya, I'll record it. Money gone, I'll record it. As simple as that. The only thing which you need to keep in mind is the accrual basis of accounting, where the focus is to record an income when you earn it. The receipt is not important. Today, I made a sale to the customer and I've earned the money, it doesn't make a difference whether I receive it today or not. The cash receipt is irrelevant. Mind the words. The cash receipt is irrelevant. Your focus is you earned it. And in terms of, you can say, expense, you incurred it. You paid it or not is irrelevant. So the moment you incur an expenditure, you might pay it later. That's okay. The moment you made a sale, you might receive it later, but you've earned it, you've incurred it, so you're going to record it to calculate the profits of the company, right? Okay, is there any profession like teacher, doctors who are allowed to record on a cash basis? Yes, but that's more from the income tax point of view, not from the accounting perspective. From the income tax point of view, professions like chartered accountants, lawyers, and doctors are allowed to follow a cash basis, but in accounting, not from the income tax perspective. As far as India or even the abroad position is concerned, everybody is required to follow an accrual basis. For the Indian position, let me also tell you, if a company does not follow an accrual base of accounting, it becomes a subject matter of report. The auditor of the company would say it's a violation in terms of recording things. So income tax perspective, yes, professionals are allowed that, but for an accounting perspective, companies would be required to mandatorily follow the accrual or the mercantile base of accounting. Right? I hope everybody's clear with the picture. We'll take more examples later, but I hope I'm pretty clear on the concept. Okay. So what we have done so far is just finished with the accounting terminology and given you the concept of basis of accounting. Okay. Now we need to give you another exposure. Now, this is important because for those who are learning accounting for the first time, this is going to be very important. And trust me, any stage of accounting, whether you're doing higher level accounting, understanding the transaction, the double effect is very important. That's how you can understand the transaction's importance. So let's take you to the second concept now. And this is what we call double entry bookkeeping. This is what is called a double entry bookkeeping. Now, I think I just made a mention, maybe in the previous class as well, that accounting was developed by a mathematician. Trust me, it was developed by a mathematician. And since it was developed by a mathematician, so what he did, he created a simple equation because, in maths, what do? You consider a left-hand side of the equation, you consider the right-hand side of the equation, and if your equation matches, left-hand side is equal to right-hand side, you say hence proved. So since this entire subject was, created by a mathematician, he was working on what is called a double entry bookkeeping. Now, watch this carefully, because this, what I'm going to do is going to create a strong foundations of accounting. So I'm going to teach you something which is called an accounting equation. So in order to give you a double effect, a double entry bookkeeping, so he created a concept which is called an accounting equation. Now, if I look at this accounting equation, this accounting equation also becomes the basis of making one of the components of financial statements that's called a balance sheet. Though we're yet to learn the art of making a journal, a ledger, and a trial balance, but before we go to the concept of journal, ledger, trial balance, prior to the concept of journal, I'm going to teach you the art of double entry, and that's called accounting equation. The equation goes like this: equity plus liability. The equation is on the left-hand side, equity plus liability is equal to assets. Equity plus liability is equal to assets. Okay, Sakshi, you got a question. What is the logic of allowing some professions to follow cash basis? That's Income Tax Act. Let's not get into that because the focus is accounting. So we'll not get into taxation perspective. We'll switch over to another subject. So I think let's not get into that at this stage. So when you're looking at the accounting equation, you're looking at equity plus liability is assets. On the left-hand side, we've got own funds and we've got loan funds, and on the right hand side, we have got assets. Now, watch this carefully. Every transaction which I'm going to give you will always have a double effect, in the sense the transaction will affect the left hand side as well as the right hand side to begin with. Because later you will say, sir, the transaction is affecting only the left hand side twice. Possible. Please hear this carefully. To begin with, every transaction will affect the left hand side and the right hand side. It is not possible that the transaction affects the left hand side once and doesn't affect the right hand side. Not possible. Every transaction which I'm going to take with you will definitely affect twice. In the sense, to begin with, it will affect the left hand side and it will also affect the right hand side. That is one permutation which can happen. Let's give you something more. It is also possible that it impacts only the asset side twice and it does not impact the left hand side. So there is a possibility that when I give you a transaction, it will impact the asset side twice. How do we say that twice? We'll see. It is also possible that a transaction impacts the left hand side twice and it does not affect the right hand side. So any permutations can happen. The general permutation combination is that if there is any transaction, it impacts the left side and the right side. So generally, it'll impact both the sides. Now, what I'm going to do with you, I know there will be huge number of questions now which will start coming in, but I'm going to follow my sequence because my objective is to first create the fundamentals. So don't let your mind run wild. And as I take transaction, you say, sir, if this happens, what is going to happen? No. Hold on to your questions. I'm going to give you a very sequential understanding of transactions in a business. We'll start a business and we'll organize the own funds and the loan funds. Block one. Please hear the chain carefully. I'm going to go in a sequence of transaction. So I'm going to organize the funds, that is own and loan funds. And with that, I am going to go to the next block. I'll make a purchase of goods on a cash basis. I'll make a purchase of goods on a credit basis. Block two. Then I'll go to the block number 3. I'll make a sale of goods on a cash basis. I'll make a sale of goods on a credit basis. Mind the blocks. And then I'll go to the block number 4, which is the most crucial one. I'm going to record other incomes and other expenses as well, apart from sale and purchase. So where we'll take a variety of combinations in terms of understanding accrual basis. So let me give you the chain of thought. I will go in a 4-block strategy in terms of explaining you the double entry bookkeeping, because the same block of strategy we would consider in journal entries as well. So we will not disturb the flow. If there are any other transactions coming to your mind, hold on to them. We'll discuss them later, not in between. We're just going to concentrate on 4 blocks to get the foundations clear. First, we'll go for funding a company. So we'll have equity and debt financing liability. Then we'll do purchase cash credit. Then we'll go sales cash credit. And then we'll go for other incomes and other expense with varieties of combination, right? So every transaction will understand what is the double effect, what gets affected on the left-hand side, what gets affected on the right-hand side. So let's begin the journey. I'm going to go slow. I know that for many of you who have got accounting background, this is baby stuff. But my objective is also to give clarity to those who are new. And even for those who knew it, I think you will get more clarity as we go step by step. No hurry, don't run fast. Okay, let's begin. Are you ready with the blocks? Can we start the journey on a double entry bookkeeping? Okay, so let's begin the journey. So I'm going to take you to, first of all, the block 1. So let's take the block number 1. So I'm creating the accounting equation, exposing you to the double entry bookkeeping. So we call this as an accounting equation. So we'll take some figures as well to understand this bit. So we're going to consider equity, that is own funds. we're going to consider liabilities, and that is loan funds, and this is equal to assets. So you'll get a little more exposed to some more new terms as well. Let's begin. My transaction number one in terms of block one is the owner provides funds. The owner provides funds. Now, I don't know if I mentioned this earlier or not. I think I did, but let me put it once again. I think I gave you the concept of what is called a separate legal entity. So if I start a company, the company is a separate person and I am a separate person. The owner and the business are two separate legal persons. So whatever you're going to record is going to be recorded from the business point of view. So as an owner, if I give money to the business, now you need to think what is the business thinking. Now, if the owner gives money to the business will say, number one, I got cash. And number two, he owes this money back to the owner. So you need to think like this. The double effect is that when, as an owner, I gave money to the business, now you need to think from a business point of view, what did the business get? The business got money, which is cash. That is one. And the business now owes this money back to the owner. And can you tell me, when a business owes the money to the owner, what do you call it, as equity or liability? When the money is owed by the business to the owner, what do you call it, as equity or liability? That's right, it's equity. When you owe it to the outsider, it's called a liability. And when you owe it to the owner, it's called equity. Wonderful. So when I'm looking at that the owner provides funds, let's say he provided funds to the extent of 2 lakh. So the equity will come to the extent of 2 lakhs. And in their assets, they will get cash to the extent of 2 lakh. You can see the impact on the left hand side as well as on the right hand side. So on one hand, the equity increases because the business says, I owe this money to the owner. And on the other hand, he also got money. That money, the cash, is supposed to be an asset. By the way, is it a current asset or is it a non-current asset? Just to recall things. And that's right, it is a current asset. And also, is it financial or non-financial in nature? Because you are getting the right to receive the money, so it is financial in nature. Super. Let's go further. We'll take a second transaction. Loan taken from State Bank of India, SBI. The company has taken a loan from State Bank of India. Okay, somebody has gone to the extent of making journal entries as well. I am not getting into journal entries at this stage. Let's go step by step. Okay, so we're looking at loan taken from SBI. Now, if the business takes a loan from State Bank of India, that means again I'm getting cash, undoubtedly. And this time I owe this money back to SBI. Is this money which I owe back to SBI is equity or liability? State Bank of India would be an outsider. So if you owe this money to the outsider, you're going to call it as what? Liability. Great. So let's consider that the money which is taken from State Bank of India is, let's say, 1 lakh. So we also going to add 1 lakh out here in the cash. I'm sure you are very clear with the block number one. We're just working on a very basic principle of a double entry, that when you receive the money from the owner, your cash goes up. When you receive the money from the outsiders also, the bank, your cash goes up. This money is owed to the owner, it's called equity. This money is owed to the outsider, it's called a liability. I hope my block one is 100% clear, right? Is my block number one 100% clear? Correct? Good. Wonderful indeed. So let's take it further. I'm just taking the total. We'll go to the block number two. We'll just take the left-hand side. This is 2 lakhs of equity. This is 1 lakh of liability. And we get assets to the extent of 3 lakh. Nothing else we're taking in block number one. Okay. Now we come to the block number 2, where we're going to concentrate on the purchase of goods. Let's go further and continue the equation. So this is equity plus the liability, and it is equal to assets. I'm just taking the previous balances. The equity was 2 lakhs, the liability was 1 lakh, and the assets, that is cash, is to the extent of 3 lakh. So this is my block number 2. We need to go in a sequence. You'll understand the things better. Don't let your mind run wild at this particular stage. Now, in block number 2, we're just going to concentrate on the purchase part. Now, as a business, I purchase goods. They could be purchased on a cash or they could be purchased on a credit. So let's begin with the transaction number 1. Purchase of goods. Purchase of goods, let's say for cash. There is a purchase of goods. Let's say it is purchased for cash. Now watch this carefully. When you're saying purchase of goods for cash, you need to think everything from a business point of view. When a business makes a purchase of goods, the cash will be given. So one effect is the cash is gone, but in return, you're getting some goods. And that goods is going to be called as stock, or it can be called as inventory. So this will result in a change, you can say, within the right-hand side itself. As I said earlier, that every transaction either could affect the left-hand side and the right-hand side, or it could be just a change on the right-hand side itself. So when the business is going to make a purchase of goods, we can say the cash will decrease because you paid money, but you are getting something in return that is called goods, and that's going to be called as inventory, or it can be called as stock. So what we'll do, let's say the purchase of goods is to the extent of 50,000. So your cash will reduce to the extent of 50,000, effect 1. And the second is you're going to add inventory, or you can call it as stock, whatever, and this will increase to the extent of 50,000. So there is an impact only on the right-hand side. Mind you, there is an impact only on the right-hand side. It's an internal change within the assets. One asset gone, another asset came in its place. It's like money went out of the pocket, but then you got something in return, which is also an asset for you. So that is purchase of goods for cash. Let's see the next one now. So let's consider the purchase of goods for credit now. So let's consider we are making a purchase of goods on a credit basis. So I'm not going to pay the money now. I'm not going to pay the money now. Now, watch it carefully. You know this well, testing time. As a business, I purchase goods. I certainly got goods. That certainly increases my asset, but I did not pay the money. Is this money going to be called as what? Is this money you owe to the outsider, or is this money which you owe to the owner? Tell me. And that's right, it is supposed to be outsider, because when you made a purchase of goods, the person from whom you purchase the good is not the owner, but is an outsider. So what will happen? You will create a liability because you still owe that money to the other person. So let's consider that you made a purchase of goods to the extent of 40,000. So your inventory will increase to the extent of 40,000 for sure. You are getting something which is creating an asset, inventory, or stock. But I did not pay the money. Since I did not pay the money, so what I will do, I will create a liability, and this liability is going to be called as a creditor. So this money which is owed to the outsider is going to be called as a creditor, mind you. So I'm just giving you some more terminology as well as we proceed with the equation. So I said when you're going to buy the goods, we're going to call it as inventory, or we are going to call this as stock. And correspondingly, you creating a liability, and this liability is going to be called as a creditor. So got my point? So you can see something very carefully. When you purchase the goods, Let me put some rapid fire questions to you. When you purchase the goods, can I say inventory went up irrespective it is a cash or a credit purchase? Am I right? That's wonderful indeed. Your inventory is definitely going up irrespective it's a cash or a credit purchase. If you pay money right now, the cash goes down. If you're going to pay the money later, you're going to create a liability. Let me just put some common sense question again to you. Once you're going to pay off the creditor, once you're going to pay off the creditors, am I going to reduce this 40,000 and reduce the cash as well? Because if you're looking at a double entry, when you go to pay the creditors, the liability should be reduced because you paid them. And correspondingly, the cash will also get reduced. Make sense? Yes. That's great. So ultimately, the net effect of the transaction would turn out to be the same. Superb. Are we clear with the block number 2 as well? Just looking at purchase, no other transaction. Don't deviate your mind in terms of any other combinations. Super. So let me just, I think, take the net figures also before we go to the third block. So this equity is to the extent of 2 lakh. The liability I'm just adding is 1.4 lakh. And if you consider the cash, it is 2.5 lakhs. And there is an inventory that is 90,000, that's 0.9 lakhs. Just see the left hand side is 3.4, the right hand side is 3.4. Perfect. It agrees. Wonderful. So we've done 2 blocks now. Now we're going to go to the third block, which will get slightly tricky. The fourth one is going to be even more tricky, but you'll get it. But don't deviate your mind if you're learning things for the first time. Go step by step. The moment your mind starts running wild, it can create problems. Let's, I think, take it further. Let's go to the block number 3. So we are now on the block number 3, where we go to concentrate on sales only, that is on a cash and a credit sale. So let me put the equation back again. Equity plus liability is equal to assets. And in the assets, I'm showing the segregation of cash, and I'm also showing the segregation of inventory or stock, what you've taken. So I think my equity was to the extent of 2 lakhs. My liability was 1.4 lakh. And I guess my cash was to the extent of 2.5 lakhs. And the inventory is 0.9 lakhs. Just copied the figures from the previous block. Okay, now let's take it further. In this third block, we're concentrating only on a cash sale and a credit sale. So let's begin with the first transaction, that is sale of goods. Now, this is, be careful. The sale of goods for cash. We're looking at the sale of goods for cash. Now, there is something new which is going to come in, because when the company will sell the goods, they will also make a profit or loss on the deal. So you're going to sell goods which are worth, let's say, 20,000. You're not going to sell them at 20,000. You're going to sell them at a profit margin. So goods worth 20,000 is going to be sold, let's say, at a profit of 5,000. So let me also give you additional data. Let's say the cost price of the goods is 20,000. And let's say the selling price of these goods is 25,000. So we're considering that when a company is going to make a sale, so they're naturally going to sell goods which are costing 20, but they're going to sell that at a profit element. So let's say at 25. Now, the main question what comes to the mind is, when the company is going to sell these goods at a profit, ultimately this profit belongs to whom? The business will make this profit, but can I say this profit ultimately belongs to the owner, and I should put this as a part of the equity? Let's get this straight. Any kind of incomes and expenses would result in a profit or a loss, and ultimately the business owes this money back to the owner of the company. So any gain, any loss on a transaction which you see is going to be adjusted in terms of equity, because the business will make this profit and tell the owner, boss, this is your money, we're going to give this to you. So let's begin. Now watch this carefully, because now you might see that instead of double, you might see triple, but it's not a triple effect. It's going to be a double effect only. Number one, when you made a sale of goods costing 20,000, would you like to tell me that you made a sale so the stock will go down? Should it go down by 20,000? Or should it go down by 25,000? The goods were sold costing 20. So when you're going to reduce the inventory, you're going to reduce by what amount? And that's right. So we're going to reduce this amount by 20,000. That is supposed to be the cost price of the goods sold. And since I sold the goods to the extent of 25,000, the money which I'm going to receive is equal to 25,000. So your cash will increase to the extent of 25,000, which is equal to the selling price of the goods. So you can see a mismatch, that the stock is decreasing by cost, that is 20, and the cash is increasing by 25. And that's for the reason we are getting a profit on sale, and this profit on sale is supposed to be given to the owner, and that's going to be added to the equity. So we're going to add that 5,000 as a part of equity. It belongs to the owner. That is a profit. So you can see it's a double effect. At the end of it, it is supposed to be a double effect, because what we are doing, we are basically accounting for 20,000, one, and we're accounting for 5,000, two. So if you consider 20,000 as one transaction and you consider 5,000 as a second transaction, you can see that you're accounting for 20,000 double effect, you're accounting for 5,000 double effect. So it's not a triple effect. It is basically a double effect. First, you're accounting for 20 double effect. Then you're accounting for the profit double effect. Got my point, right? So this is as far as the sale of goods is concerned, that is on cash. Let's consider if it is sold for credit. Let's say if these goods are sold on a credit, let's take a different little picture. So let's consider now the cost of the goods is 25. Let's consider the cost price of the goods is 25, and let's say the selling price is equal to 28,000. Let's say the selling price is 28. Now let me put some quick questions to you. Can you tell me what will be the reduction in the inventory? You're selling goods worth 25 at 28. What will be the reduction in the inventory? Superb. It's going to be 25,000. That's absolutely correct. I am not getting a cash because it is a credit sale. So can I say I am going to create another asset, and let's call that as a debtor. So when you made a purchase from a supplier, he's called a creditor. And when you make a sale to a customer, he's called a debtor. So you're going to create a debtor. And can you tell me at what figure? 25 or 28? The goods are costing 25, but they're sold at 28. So you're going to create a 28. Superb. And undoubtedly, needless to mention, there is a profit of 3,000 on the deal, and the 3,000 belongs to the owner. So we're going to add that to the amount of equity. So let's do one thing. So in this particular case, first we reduce the inventory to the extent of 25,000. That is, the cost of the goods has been reduced. And we are creating another asset, and that is called a debtor. And this will be created to the extent of 28,000, which is the selling price. And again, we can clearly see that this is increasing by 28 and this is decreasing by 25. So there is a profit of 3,000 on the deal, and this money belongs to the owner. That is called equity. Very systematic. So moral of the story is very clear. I think in the block number 3, we are concentrating on the sale of goods for a cash and sale of goods on a credit. So let me, I think, say some rapid fire questions to you. You can vouch me. Can I say, irrespective it's a cash sale or a credit sale, inventory goes down by the cost price? Am I right? And that's wonderfully correct, because we are reducing the inventory by the cost price, irrespective it is a cash or a credit sale. Can I say the profit on sale goes to the equity irrespective it's a cash or a credit sale? You make a sale and you're putting that profit in the equity, accrual basis of accounting, you're booking that profit. Great. And you can notice logically, if you're receiving cash, you increase the cash by the selling price. If you don't receive the cash, you're going to increase the debtors by the selling price. Just a very quick question. Can I say once this money is collected from the debtor, can I say this will decrease by 28 and the cash will increase by 28? Am I right? So once you get the money collected, this decreases by 28 and the cash will increase by 28. Simple and straight. Good. I think now you've got a complete hang. So my block one is done. Financing, equity and loans. Second is purchase, cash and sale. Third is a sale, cash and a credit. So we've done purchase, we've done sale. Now comes the fourth block. But before that, let's take the balances before we go to the fourth block as well. So let me just add this. This is, I think, 2,08,000 is the equity. And my liability still continues at 1,40,000. And if I consider my cash, it is, I think, 2,75,000. And if we consider the stock, I think it is coming at 45,000. And there is a debtors to the extent of 28,000. Please verify, is the left-hand side and the right-hand side agreed? This is 348. Just see if this is also 348. I think, yes, it is 348. Perfect. So far, so good. I think let me still ask a few questions to you at this stage. Is everybody absolutely comfortable till the three blocks? Don't think of transactions other than what I've given you, but are we 100% clear so far on the three blocks with you? Great, superb indeed. So if you have got any questions, we'll discuss later, but not pertaining to these transactions. Some of the transactions, just keep them aside for the time being. Okay, let me now go to the block number 4. Let me just pick up these balances. So I'm going to my block number 4, which is the very interesting block. This will definitely trigger thoughts because this block is devoted in terms of giving you understanding on accrual basis of accounting. So we've got equity and we've got liability, and this is equal to the assets. And within the assets, we've created items like cash. We've created items like inventory, or you call it a stock. And I've also created item which is debtor. So though even in terms of liability, I have created, there is a loan. And I think let me also create a creditors as well. Just for a better understanding, let's give you the breakup of liabilities and the assets. So let me pick up the balances. This is 2,08,000. So the equity is 2,08,000. And I guess I took a loan which was to the extent of 1 lakh. So loan was to the extent of 1 lakh. The creditors was to the extent of 40,000. And we've got the breakup in terms of cash, 275. Inventory is 45. And the debtors is 28. I've just taken the balances from the previous block. Okay, so far so good. Now, friends, be a little careful in terms of what we are doing, because you will get slightly disturbed. But if you hear me carefully, you will 100% get the concept. So please watch this carefully, because I'm going to take a total of 6 transactions in this block. I'm going to consider expense. I'm also going to consider income. I'm going to consider 3 variations of expense, and I'm going to consider 3 variations of income as well. Now, watch this carefully. I'm just trying to take a recap and remind you the concept of accrual basis of accounting. Let me ask you again what I gave you a few minutes back. Am I supposed to record the expense even if it is not paid? Am I supposed to record an expense even if it is not paid? I am making accrual basis of accounting, and that's right. Now, I'm just adding one more element. I am supposed to record an expense which is for the year and what is incurred. I'm adding two things now. Accrual basis means it is for the current year. So when you're going to record the expense, the first important input is the expense is incurred for the year. Every year expense will be recorded in that computation of profit. So you need to consider an expense, it is for the current year, and the moment it is incurred, irrespective it is paid or not. So let's do one thing. Let's first put some questions to you. Before we record, let's put some questions to you. Number one, I'm now going to tell you that since in this case I am considering equity, any income belongs to the owner. Any expense will go to the owner. So if I'm going to incur an expense on accrual basis, I will definitely reduce equity because the expense is ultimately borne by the owner. So if there is going to be an expense, I'll reduce the equity. And if there is any income, I will add it to the equity. The incomes and the expense would result in a profit. So every income which I'm going to talk of is going to be put in the equity. Every expense is going to be put in the equity. So one effect is very clear. If you say that it's an income for the year and it is earned, I'm going to add equity. If you say it's an expense for the year and it is incurred, I'm going to reduce equity. So get this clear. The moment I reach a conclusion that this is the expense for the current year and it is incurred, I'll reduce equity. The moment I reach a conclusion that's an income for the year and it is earned, I'm going to add the equity, reduce the expense from the equity, and add the incomes to the equity, provided you are able to prove it is for the current year and it is incurred. Let's begin. You just need to decide, am I going to reduce equity or not? Just one effect. We're not going with the double effect right now. We'll just think of one effect. There is an expense for the current year paid. Should I reduce equity? There is an expense for the year and it is paid. Do I reduce equity? And I'm getting a big answer, no. Let's get this again. I gave you some fundamental principle, and that fundamental principle is incomes to be added to equity, expense to be reduced from equity. Please hear this carefully. Incomes to be added to the equity, expense to be reduced from the equity, provided two conditions are met. It is for the year, irrespective it is paid or not. Let's do one thing. Let's make your life simple. So I am looking at income. I am looking at expense. I'm looking at income, I'm looking at expense, and I'm looking at the equity in my equation. So please hear this carefully. I said it is an income for the current year and it is earned. It is, let's say not earned, let's say it is received. Let's say it is received. Please mind the words carefully. It's an income for the current year and received in cash. Are you going to add equity? Yes or no? Are you going to add equity? Yes or no? Think carefully. I am getting still answers in between no. Majority is yes, but one or two said a no. The answer is, of course, a yes. It is for the current year. You received it. Please add it to the equity. If it is for the current year but not received, will I still add to the equity? If it is for the current year, but it is not received, are you still going to add to the equity? Yes or no? Accrual. And that's right. So what is important is that it is for the current year. What is important is that it is for the current year. Whether it is received, add equity. Not received, add equity. Why? Accrual basis of accounting. Did you get my point? So we are following an accrual basis of accounting. So you receive it, I still add equity. You don't receive it, I still add equity. Cut the point. Now, the next question is, it is for next year. It is for next year. Are you going to add it to the equity? Think carefully. You've received something not for this year, but for the next year. Is that an income for the current year? No, it's not an income for the current year. Since it's not an income for the current year, you cannot add it to equity. So what is the most important aspect in terms of income and expense? It should be for which year? Tell me. When you say that it is for which year, that's right. The focus point is it is for the current year. You need to get it very clear. I need to consider it is for the current year. I received it or not, I don't care. But if it is not for the current year, it's not income for that year. So you are going to add incomes only when it is for the year, that is current year, received or not received. If you're clear, let's put the questions now. And you said, is it a deferred revenue? We will come to that part. The double effect we'll come to. Right now, I'm just looking at the impact on the equity. We'll look at the impact on the second effect of the equation very shortly. Okay, let's now go to the expense. Now, in terms of the expense, we are saying it is for the current year, it is paid or it is not paid. Are you going to reduce the equity? Say yes or no. So we're looking at it is for the current year, and in this particular case, we are saying it is paid or not paid. Yes, I will definitely reduce the equity. Because what is the focus point for the current year? Please mind it carefully, for the current year. So I will reduce the equity. But let's say if it is paid for the next year, are you going to reduce the equity? If it is paid for the next year, are you going to reduce the equity? Of course not. So I've just given you a little extension of accrual basis. Let me fit this once again into your minds. I've just given you a very basic input on the accrual. Earlier, I said you're going to record incomes when they're earned. Received or not received doesn't make a difference. I'm still sticking to that. Received or not received is not the agenda. But there is another important aspect that it should be for which year? Current year. Similarly, on accrual basis, I said you're going to record an expense when it is incurred. Paid or not paid doesn't make a difference. What is the other focus point? And that is current year. So from now onwards, when you go to say that yes, it's an income to be added to the equity, or when you say it's an expense to be reduced from the equity, what is going to be the focus point? Tell me. What is going to be your focus point? So when you go to say that it is to be added to the equity or it is to be reduced from the equity, what is your focus point? That it is for which year? And that's right, it should be for the current year. If it is not related to the current year, you can't add the income to the equity. You can't reduce the expense from the equity. What we're going to do, we'll see later. We'll see later. So let's come back on the equation. Now we are ready to go with some permutations and combinations. So watch me carefully because I'm going to take three combinations with you. And we're going to carefully see the permutations, combinations to begin with. So let's, I think, begin with, first of all, transaction number A. It is for the current year and it is paid. It is for the current year and it is paid. I'm focusing on expense. I'm focusing on expense. It is for the current year and it is paid. Do we reduce equity? Yes or no? It is for the current year and it is paid. Yes, I will reduce the equity. So let's say you paid an expense to the extent of 10,000. And what will be the double effect? Since the expense is already paid, what is the double effect? You reduced it from the equity and you're also going to pay money. So your cash will reduce. So what I will do, I will reduce the cash to the extent of 10,000. Super. That's great. Wonderful indeed. Let's go to the next year. It is for the current year, but it is not paid. It is for the current year, but it is not paid. Are you going to reduce the equity? It is for the current year, though it is not paid. Are you going to reduce the equity? Yes. So let's say it is to the extent of 5,000. But since it is not paid, so this is minus from here, minus from here. But since it is not paid, but it is supposed to be paid, and if it is supposed to be paid, is it to be paid to the owner or the outsider? It is going to be paid to the outsider. So you're going to create a liability, and we're going to give a name to this liability. And in accounting, we give it a name, outstanding expense. So what are we going to do? We will increase the liability to the extent of 5,000, and we're going to call this as outstanding. In short, we put it as O oblique S. That's called outstanding expense. Very good. So the double effect still matched. Did you notice something, that in this particular transaction, everything is getting affected on the left hand side? You can see there is a plus and a minus on the left hand side, no impacts on the right hand side. As I said, every equation will get affected like this, either on the left and right, 1, 1, or it could be left, left on left hand side, or right, right on the right hand side. You've seen transactions where only right hand side was getting affected twice. You've seen transactions where left hand side is getting affected twice, and you've seen a couple of transactions where the left and right is getting impacted. This is what is called a double entry bookkeeping, where every transaction will impact on the left and right, or maybe just left hand side twice, or maybe just right hand side twice. Right? Let's now go to the next one. Now the third one is good. We paid an expense for the future year. We paid an expense for the future year. I paid this money not for the current year, but for the next year. Are you going to reduce the equity? Is it for the current year? No. So you cannot reduce the equity, but I paid cash. So what I'll do, I'll reduce the cash. Now the question arises, what is going to be the double effect of this transaction? If you paid the money for the next year, can I catch that person and tell me, give my money back? Do you get the right to receive the money back from him? Or maybe you get the right to receive the goods against this money which is paid. So it is going to create what is called an asset. So when you pay an expense not for this year, but when you pay an expense for the future year to come, in those particular cases, we can say that you've created an asset. So what we're going to do, we're going to create an asset. Let me just add 5,000 out here. And we use the word, it is called prepaid expense. We use the word, it is called prepaid expense. So you can see the nomenclature. When it is not paid, we say outstanding expense. And when it is paid, you call it as a prepaid expense, or you can also say it's an expense paid in advance. You can say prepaid expense, or you can say expense paid in advance, one and the same thing. Okay, so far so good. Slightly more technical as compared to the previous blocks, but I hope you've got the picture. Let's make it very clear. Rapid fire questions before we go to income. If you've understood the expense accounting, you'll easily pick up the income accounting as well. So put some rapid fire questions to you. Okay, so I'm getting some entries as well. That's great. Can I say if you incur an expense for the previous year, equity goes down for sure. Paid or not paid, I don't care. Correct? If there is an expense which is incurred for the current year, it's going to reduce the equity. Paid or not paid, I don't care. That's wonderful indeed. Next, if you pay an expense for the future year, cannot reduce your equity. Correct? And that's wonderful. Now, small little question. If it is not yet paid, do you create a liability or an asset? If it is not paid, do you create an asset or a liability? Not yet paid. So it'll create what liability? Outstanding expense. Great. And if it is paid in advance, do you create an asset or a liability? Undoubtedly asset. That is called a prepaid expense. Wow. By the way, this prepaid expense is current or non-current. Outstanding expense is current or non-current in nature. So you're going to pay it, I guess, logically within a period of next 12 months or receive it adjusted in 12 months. It is current in nature. Superb. Great. So let's take these balances with you. I guess let me just quickly take the balances and take you to the income. So we're going to continue with this block, but let me just take the balances quickly. So this is going to be minus 15. How much would this be? Anybody can calculate the equity to me? So this will be minus 15. I guess it is coming to 193, is it? The equity is 193. Correct. That's right. So we take this as 193. Let me take the segregation of the liability. The loan is 1 lakh. The creditors are 40. And the outstanding expense is 5. And this cash becomes, I think, 260. And my inventory remains at 45. My debtors are 28. And there is a prepaid expense 5. Just see is the left hand side and the right hand side is in perfect agreement. So I think this is 45, 145, 193. Just see left and right side is tallied, is it? Yes. Okay, that's wonderful. So let's, I think, take it further. Let's continue with the block 4. We're continuing with the block number 4 only, continued. We're now going to take the incomes into account. So let me just copy the equation. Equity plus liability will give you the segregations of the liability as well. And it is equal to assets. We'll give the segregation of the assets as well. So we've got cash, we've got debtors. Rather, first, let's take inventory. So we've got inventory, that is stock. Then we've got debtors. And then we've also got the prepaid expense. And here we've got loan, we've got creditors, we've got outstanding expense. I'm just going to copy the figures from the previous part. So this is, I think, 193. This is equity is 193. The loan is to the extent of 1 lakh. The creditors of 40,000. And the outstanding expense is 5,000. And we look at the cash balance as well. This is 260. This is 45,000. We got a debtors of 28. And we've got a prepaid expense of 5. Okay, wonderful indeed. So this is done. Now it's going to be testing time. I think if you can answer the questions, the 3 questions coming in, then your fundas are going very, very good. And I'm pretty confident that you will be able to answer the 3 questions pertaining to the incomes coming in. So let's begin the journey. Let's consider the variations of the incomes to you. So we're going to consider 3 variations, A, B, and C. The income is for the current year and it is received. The income is for the current year and received. Do I add the equity or not? And wonderful indeed. I got the right answer. Yes, we'll go to add this because if it is income for the current year, I am going to record it in the equity. I receive it or not, I don't care. So let's say this is to the extent of 10,000. And would you like to give me a double effect as well? You've received this money, so what's going to be the double effect in terms of the equation? So when the income is received in cash, the double effect is the cash will go up, and that's rightly said. So let's increase the cash to the extent of 10,000. Wow, that's correct. Next, let's say it is for the current year, but it is not received. It is for the current year, but it is not received. Are you going to add the equity as well? It is for the current year, but though not received in cash, are you going to add the equity? Yes. So we are still going to add the equity. The focus is very clear that it is for the current year. I don't care whether it is received or it is not received. But since I did not receive the cash, I cannot increase the cash, but I will get it later. So it would also create an asset, and you can call this as technically income accrued. So this income, which is, not yet received. So you can call it as income not received, or you can use a little technical word and call it as income accrued. So what we're going to do on the asset side, we are going to add another asset and call it as income accrued. And this is to the extent of 5,000. This gets added on the assets. Right. So this is increase in equity and there is increase in terms of asset. The money which is not yet received but would be received later, so it becomes accrued income. By the way, current asset or is it non-current in nature? This is a money which is going to be received, I guess, in a couple of months only. So we're going to call this as what? Current asset in nature. That is right. Okay, brilliant. Now, there is an income received for the future year. We received some income not for this year, but for the future year. Are you going to add the equity in this case? You receive this money not for the current year, but it is received for a future year. So are you going to increase equity? That's right. No. But I definitely received a cash. So I'm going to add the cash to the extent of 4,000. Can the other person catch my collar and take this money away from me? Yes, I am under an obligation to pay this money. So I'm going to create a liability, and you can call it as income received in advance. We don't call it as prepaid. So we're going to call this as income received in advance. So we're going to use the terminology income received in advance, and you're going to increase the liability to the extent of 4,000. Left hand side, right hand side, undoubtedly will agree in this case. Wow. So I think we've learned a total of 4, you can say, terminologies as well. When we are discussing the concept of incomes and expense, we've indirectly also learned some few terminologies like outstanding expense, like prepaid expense, like income received in advance, like income accrued as well. Are we 100% clear so far on my block number 4 as well? Getting the variations of the expense and getting the variations of the income. So far, so good. Everybody clear with the picture? Okay, that's wonderful indeed. So now a few little questions back again out here. So my blocks are done. I want to, before we go forward, and you can also, I think, ask your questions now. I've been keeping your questions pending for some time, but let me just give you a quick chart. Then you can put your questions if you've got any. I'm now going to give you 4 items which you've already seen. You just need to decide its asset or liability, because sometimes it creates a confusion. So I just want to put this as a summary. Just to be on a very safe side, I'm just going to give you the 4 terms. So let me give you the 4 terms. You just need to decide that is it going to create an asset or is it going to create a liability? Let's put the first term to you. Okay, I'm getting a question. So what is the difference between income accrued and a debtor? Good question. Well, if there is a sale of goods, that's revenue, and that would create a debtor. But if there is something which is not a sale of goods but other income, we're going to call it as income accrued. So when you are making a sale to the customer, it's a business operation. So you're going to call him as a debtor. But when there is some other income not related to the business operation, then we don't use the word debtor, we use the word other income accrued. Similarly, when you are making a purchase from a supplier for goods, we're going to call him as a creditor. But when it is for expenses not related to business, not related to goods, I would say, then it is called expenses outstanding. So generally, we use the word debtor when it is a sale. Other than that, we don't use the word debtor. Similarly, when you're making a purchase, we use the word creditor. Other than that, goods, other than goods, we use the word, accrued expense, etc. That was a good question. Did you get your answer, I guess, Mayuri? Okay, so let's now give you 4 items and you are going to tell me it is creating a asset, liability, whatever. Outstanding expense. Tell me, what is an outstanding expense going to be in the balance sheet of the company? Liability or an asset? Great. It is undoubtedly a liability. Very good. Next, there is an expense which is paid in advance. I made some expense payment in advance, asset or liability. Very good. It creates undoubtedly an asset. So this was as far as the expense is concerned. If it is not paid, liability logically. If paid something in advance, creates an asset. Okay, next, accrued income. The next one is accrued income. So what does it create? An asset or a liability? Somebody is saying it's a liability. The income which is not yet received. So it is asset for me. This is going to create an asset, not yet received, but I will receive it later. It's an asset. Next, there is, let's say, income received in advance. I received an income in advance. So is it asset or is it liability? Undoubtedly, this is going to be liability. Right. So this was just to give you a summary position in terms of the terminology we've used in terms of things. Wow, super. Okay, let's first ask you if you've got any questions on the accounting equation. I've given my 4 blocks to you. I've already got one question. So when we receive the money for revenue of a future year, can we call it as a deferred revenue? Well, later on you would see, yes, as per the standards, like for example, if you look at US GAAPs and IFRS, we do use the word deferred revenue as well. Yes, we do call it as deferred revenue. I'm not using those terminology because as you're going to go forward in terms of understanding the US GAAPs or in terms of understanding IFRS, you will see that these terminologies will be different. I'll give you one sample, for example. I have been using the word today inventory, or I've been using the word stock. But later on, you will see that stock is a word which is used for the share capital of the company. In US GAAP, they use the word called common stock. In India, what you call ordinary shares is called in US GAAPs as common stock. So they're not going to use the word stock for the inventory. They're going to call it as inventory only. So you might see certain change in terminologies happening because the terminology what we are using in India is of course slightly different as compared to what you use in US GAAPs as well. So that kind of terminology you're definitely going to see. Yes. Okay, so let's take it further. Okay, now, any further questions coming to your mind? So far, so good. Okay, deferred revenue is revenue for more than a year. Not necessarily so. You can't say that if it is deferred. I think you may be making a reference to deferred revenue expenditure, but there's technically nothing called a deferred revenue expenditure. That concept has been totally done away with. Accounting is still there in schools, but it's not a relevant concept. Okay. Now, let me just consolidate the picture before we go further. What I have done today so far is only giving you an exposure in terms of what is called double entry bookkeeping. Now, what is this concept of double entry bookkeeping? Every transaction in an accounting equation is going to affect double. Either it is left and right combination one, or it is just left and left twice, or it is just right twice, right? So the impact could be just twice on the left hand side, twice on the right hand side, or once on the left hand side, and once on the right hand side. But you should be able to visualize the double effect of a transaction, that any transaction occurs, how it affects the, two things in this. So I created a certain block of things with you. The first block was in terms of financing the business. The owner puts in money or the outsider puts in money. We saw that block one. Then we systematically went to the block number 2 and we consider that in this particular case, it is a purchase, cash or a credit. Then we went to the block number 3 and we said it is a sale, cash or credit. But the sale was also resulting in a profit or a loss on sale, which is also going to get adjusted in the equity as well. Because when you're going to make a sale or purchase, it'll result in a profit loss, which is going to get adjusted in equity. And the last block which we saw was in terms of income and expense. And when you're looking at income and expense, we're looking in terms of accrual. And we've seen two very important features, that it should be for the year received or not, I don't care. It should be for the year paid or not, I don't care. But if it is not for the current year, but it is for the coming year's future year, it doesn't hit your equity. And accordingly, if it is received or not, or if it is paid or not, you can get terms like outstanding, prepaid, advance, whatever. Let me now get your questions. If prepaid expense is paid for 2 years, will it still be current asset? You see, if you paid for 2 years, what is paid for 1 year becomes current. And what is paid for the second year becomes non-current. Because whatever you paid, the benefit of what you paid for the next 1 year is going to be current in nature. And the benefit of what you paid for the next 2 years, that is for the second year, becomes non-current in nature. Did you get my point? So if you, let's say, made a payment for the next 2 years to come, the benefit of some portion will get exhausted in 1 year current. The benefit of some portion gets exhausted in the second year. Did you get the answer? Okay, so far so good. Now, I want to first get your comfort zones. As I said, I'm a little bad habit of taking some comfort zone scores as well. So whatever we've learned today, I want to understand what is your comfort zone on a 1 to 10 scale on this accounting equation. Before we take the journey forward, let's get your comfort zones on that. I got a big question. I'll just come back to your question. Let me first get your comfort zones on 1 to 10 on the concept of accounting equation. 9, 10, 10, 10, 9. Wonderful indeed. Majority's got a score of 10 or it's 9. That's excellent indeed. Superb. There is a small little question which is coming in. The question seems to be quite big in nature. Simon, you had a question. So when we sell goods as per the equation, stock and cash gets affected, but the recording we do on the sales. You are running a little on the journal entry part. I am not going to touch the journal entry part step by step. I personally believe, if you're going to get your fundas on a step by step, you'll get it clear. I know your question very well because what I've taught you today, when I'm going to come to the aspect of journal entry, I am slightly going to make some changes in the terminologies and a bit of the concepts as well. So don't get worried. Your question will absolutely, get answered in later on. Okay, now before we end, I am just going to take one or two simple complicated items. We're just going to take one or two simple transactions based on this equation just to test you. So testing time. There's going to be now a little testing time before we close. So I'm just giving you one or two transactions. You need to decide the transaction. Equity plus liability is equal to assets. I'll just give you two transactions. Please see this carefully. I purchased a machine, let's say for 1 lakh in cash. Please give me the double effect. I purchased a machine for cash because till now I was looking at purchase of goods. Now I'm saying I purchased a machine for cash. Give me the double effect. All right, so you rightly said what I'm going to do. I will increase the assets by the machine. Let's say it is 1 lakh. And what is the double effect? So machine gets increased and yes, the cash should get reduced to the same amount. So we're going to reduce 1 lakh of cash. Wonderful. That was not the test. That was not the test. The real part comes now. Now let's say this machine has been utilized and that's what we call as depreciation. Let's say the life of the machine is 10 years and 1 year is already passed. So that's what you call a depreciation. So we have used the asset to the extent of, let's say, 1 year. So you're going to get a depreciation. Would you like to tell me that if there is a depreciation, you'll definitely agree I should reduce the machine value to the extent of 10,000? And what do you do correspondingly? Is the depreciation an expense? Yes, it is. And if it is an expense, could you tell me what will be the double effect of this particular transaction? I like it. Wonderful indeed. So what are you going to do? Correspondingly, you will reduce this depreciation. This is an expense and this depreciation will be reduced from the equity as well. Wow, that's what I wanted to hear. So when you say that there is a use of an asset which will decrease the value of the asset, correspondingly, it is also going to make a reduction in terms of the equity as well. Superb. I like it. That's wonderful indeed. Right, friends. So I think my journey on the concept of accounting equations is done. So what we're going to do tomorrow with you, I am going to start with the concept of journalizing transactions and we're going to consider all these 4 blocks as self. So what I want you to is please make a revision of all these blocks what we have done, because I'm going to take the same blocks with you and we're going to learn the art of making journal entries tomorrow with you. That's all for the day. So please make your revisions and we're going to see you tomorrow, same time. Thank you very much indeed. Thank you, all of you. So see you tomorrow. Have a good day. Bye bye and take care.